What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this afternoon. So we have a lot to cover throughout the entirety of this video. Right now, AMC is up almost 10.5% on the day after a monster red day yesterday. In the live stream last night, the morale actually seemed pretty good for everybody who was in there. I think at this point in this short squeeze play, we all kind of understand the type of manipulative price action that we are going to be able to see out of AMC. And I think people are fully prepared for what is going to happen going forward. So what I have for you guys in this video today is a little update on why we are seeing the price action that we are seeing in terms of a very kind of peculiar type of gamma squeeze. We also have to talk about that utilization number that is being reported to us by Ortex. We are seeing that number continuously increase, essentially day over day. I am expecting it to increase even further in the future. And when the utilization starts to go up, that leads the potential for a forced share recall to increase as well. Now, in addition to this, we also have this whole market liquidation situation really heating up. Warren Buffett has made comments about derivatives in the past, and the derivative exposure of the top 4 commercial banks at the current time is absolutely massive. And you guys are not going to be very surprised at which institution those actually are. It's very similar to what we have been seeing when we talk about the different institutions who have been essentially liquidating their portfolios and putting them into safer investments. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button. So when we pull up the option chain for AMC, we're going to be taking a look at the put option. So a lot of people refer to a gamma squeeze in terms of the call options, but there's an interesting phenomenon that happens with the puts if the puts go in the money and then out of the money. So we've seen a high amount of open interest on this $30 strike. Yesterday, the open interest was over 20,000, and it has now dropped back down to about 15,500. So what we saw in this situation is that all of these over-leveraged shorts on AMC really tried to push the stock down to this $30 price in order to force the institutions who have sold these options in order to go out and actually hedge these contracts by entering into a short position. Now, what we've seen today is the stock has rallied a very significant amount. What the institutions have done that basically engaged in those short-term shorts is they realized, well, we don't necessarily need all of these open short positions anymore, so they cover those shorts and add a little bit of buying pressure that is definitely contributing to the price action that we have seen today. Now, when we move over to Ortex, we can see here that the short interest is up today at the current time 0.53% and the short interest 15.47%. But what's kind of weird about this is that the borrowed shares, it's on a 2-day delay. So 2 days ago, we saw a pretty significant red day for AMC. I don't believe for 1 second that they were basically manipulating the stock with 1.37 million borrowed shares. That doesn't seem very likely compared to the amount of volume that we have seen for AMC. But when we take a look at this utilization number, we have seen 7 days ago the utilization at about 88.25%, and now we are at 91.89. This means that the shares that institutions are willing to lend out versus the amount of shares that they have already lent out has been increasing. So say, for example, the institutions have 100 shares that they are able to loan out. At this time, when we're looking at AMC, they would have loaned out about 92 of those shares. So there's a scarcity aspect involved of how these other institutions who want to short AMC, it's going to be more difficult for them to get their hands on a lot of these shares. So the cost to borrow ends up going up as we see utilization go up as well. And we see the potential for a forced share recall increase as well. We saw this happen back in the beginning of June, where the utilization was at 100% and the stock started ripping because partially, most likely, a couple of these shorts were forced to cover due to the utilization being so high. Now, there's a couple of different reasons for this. One of them is that since the cost to borrow is going up, the institutions that are loaning out these shares can then take these shares back, then loan them out at a higher rate and make themselves more money. Now, let's get into this market liquidation situation. If you guys have been following my channel for any extended period of time, we've been talking about the fact that institutions are going to start deleveraging a lot of their positions, liquidating them out of their portfolios, and putting that new liquidity, cash, whatever you want to call it, into safer investments. We've started to see this play out over the last couple of weeks. We've seen Goldman Sachs come out and say they sold 25% of their equity positions in the second quarter of 2021. We saw Morgan Stanley come out and suggest a 10 to 20% drop. We saw Citigroup say something very similar, and Credit Suisse start to move into gold. So we have this article right here. U.S. banking system has a $168 trillion nightmare looming. It was ignored in written testimony for today's Senate banking hearing. So shout out to Katniss AMC for putting this article out there. This is a really important thing that you guys need to understand. Now, before we get into this derivative situation and why it's important, we need to define exactly what a derivative is. When we come over here to Investopedia, the most basic definition of a derivative is a financial security with a value that is reliant upon or derived from an underlying asset or group of assets, a benchmark. So when you think about options contracts, they derive their value from the underlying asset. So options are a form of derivative. So are swaps, so are futures. There's a couple of other different types of derivatives as well. But when we zoom in right here to see the top 4 commercial banks and their derivative exposure, JP Morgan Chase number 1 with 52 trillion, Goldman Sachs right here with 50 trillion, Citibank 46 trillion, Bank of America 18 trillion. Now, when we look at the top 4 commercial banks and their total derivative exposure, 168 trillion. All of the commercial banks, 188 trillion. So when we see here that the derivative exposure is concentrated in the top 4 large institutions, and a lot of these institutions that are listed here, Goldman, Citi, and Bank of America, have come out publicly and basically given us signs that a major market event is coming. Now, why is this important that they have so many of these derivatives in terms of a dollar amount on their balance sheet? When we come over here, we've talked about this a little bit in the past, but Warren Buffett is completely against the use of derivatives. So he's talked about before what is called a derivatives time bomb. A derivatives time bomb is a descriptive term for possible market mayhem if there is a sudden opposed to orderly unwinding of massive derivatives positions. The time bomb, as a reference to derivatives, is a moniker attributable to Warren Buffett. Now, he also says down here that derivatives are financial weapons of mass destruction. And when you think back to the global financial crisis that happened in 2008, derivatives played a major role in that situation happening. Now, scrolling down a little bit further, the issues with derivatives arise when investors hold too many, being over-leveraged, and are not able to meet margin calls if the value of the derivative moves against them. So we know that there is a massive amount of over-leveraging going on right now in the United States. We've talked about this a lot, and all of you guys should understand that the total margin debt right now is approaching $900 billion. So we're seeing a lot of over-leveraging going on. The Fed has even come out and said that the hedge fund historical leverage levels are well above what their historical averages should be. Something is brewing in our broad markets, and we are also seeing Bank of America set up for something very interesting. So there have been some people coming out and saying that Bank of America, it's very possible that they are preparing for some sort of bankruptcy event. It's possible, but I also think that they are just trying to protect themselves from really substantial losses when this major market event starts to happen. So something that I want everybody to look out for is if Bank of America starts to offer off of this shelf offering. So when a shelf offering comes out, it's essentially saying, hey, we're going to register all of these securities that we can offer from time to time on this one document, so we don't have to keep coming to the SEC and registering every single time we want to make an offering. It just makes the process more smooth and efficient. So if Bank of America over the next 2 months starts to really crank up these offerings, it's going to suggest to us that they think that the major market event is coming sooner than expected. Now, there are a lot of projections that Q4 could be the time, but again, no dates, no price expectations, especially when it comes to AMC. So when we're connecting this all back to AMC, we know that all of these institutions are wildly over leveraged. We know that their derivative exposures are incredibly high right now. We are seeing the utilization on AMC start to come up. And we are seeing the option chain start to benefit us as AMC shareholders. So there are a lot of things working together in our favor. We have the FTDs coming up on tomorrow and Monday, which again could be nothing, but it could be something as well. So the FTDs, when they come, the T plus 35 dates, I view them as either neutral or bullish. We also have earnings coming up for AMC on Monday. So with all of these things combined together, we have a lot of good things to start looking forward to as AMC shareholders. So I hope you guys are excited. I am super pumped for what we have coming in our near future. And I honestly couldn't care less about the price that they are showing on the screen. That's just kind of where I'm at with all of the DD and the research that I have done. What I think to myself in my head is one simple question. Have the shorts covered? If not, then there's nothing in my opinion that I am worrying about. So that is going to conclude this update on AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button. So that is going to wrap up this one. I'll see you guys in the next video, and I hope you guys had a great day.